Hey, Dustin. It's a short
Hello.
week, but we have
It's
a
a
lot.
wonderful week. It's a
It's
thankful
a
week.
wonderful. So tomorrow is Thanksgiving. Markets are closed. Friday is what, a half day for the markets?
Yeah, I think markets close at 1 maybe. You could check
One
earningshub.com to
Eastern?
see, yeah, Eastern. Yes, the only
Okay.
time that I think of.
Yeah.
And Friday is also Black Friday, one of my favorite
Yes.
holidays.
Get
Great.
everything on sale, including Earnings Hub. All right. We have a lot to cover, actually. So should we just jump into it?
Yeah, let's do it.
You want to
So,
you want to talk about all this stuff and then
oh,
and
yeah,
then
yeah, yeah. So we're going to talk about you made a big sale this week. I took a little bit of profit this week on a different holding. We're going to talk about Michael Burry shorting Nvidia and Palantir. We're going to talk about Nvidia's GPUs versus Google's TPUs. And then we have some general questions for uh, us to go over and listener questions, as always. So write in your listener questions if you have them.
And you can write the questions now, by the way, even or as you're watching, if something comes to mind, you can write it, comment about it, and then Adrian will collect all the questions and start rapid firing them towards the end of the episode. What should we start with first, Dustin?
So I want to start with your portfolio. You finally cracked and
Yeah,
sold American Eagle,
I
which,
did.
if you recall, I was questioning that investment in our first episode of the podcast.
Yeah,
Um,
yeah.
so I want to know what changed. Why did you sell it now?
Well, first of all, American Eagle stock shareholders should thank me because I sold it and it's up another couple of dollars since I've sold it. I think over 10% since I've sold it. So I sold it after Ross and Gap reported earnings, and both of them beat. Both of them are retailers in the same industry, and they both beat estimates, which caused American Eagle to go up, a handful of percents. This is like the past week of American Eagle here
Oh,
in this
wow.
graph. So,
Yeah,
um,
15%, 16%.
yeah. And then uh, yesterday, Urban Outfitters reported, but I had already sold by yesterday. So the reason I sold is because I don't know retail. It's out of my wheelhouse. And American Eagle got a pretty big boost just from Gap and Ross's earnings. And therefore, it just makes it riskier, right? So if their own earnings is not going to have a pretty significant beat, then it might have to give back all of this upside that it has just taken. So the upside has been based off of other people's results, and I'm a consolidate kind of person anyway, like investor. So I wanted to consolidate my investments. I had already traded in Google for Meta the previous week, and yeah,
So
so
you're found down to 5 stock positions, right? It's 5 stocks,
that's
cash,
right.
and Bitcoin.
Exactly. So I'm down to five, and in fact, like I can tell you exactly why I own the five that I do. I own Robinhood because it's the future of finance. I think that the next generation is going to all be on Robinhood, and as these as the sort of younger people start to inherit all of the finance of their parents and grandparents and so on, it's going to all funnel over to Robinhood, and these guys are executing on everything finance related and banking products very well. I'm not happy about their sort of betting systems, but that is also generating a lot of revenue. Um, I own Rocket Lab because the future of space is huge and it's going to continue to grow as the cost to access space drops. I think the desire to put more things into space is going to only accelerate, whether it's communication satellites or science-based satellites or telescopes or even humans or missions to the moon and Mars, and just even tourism can become a thing if the costs drop pretty significantly. So super bullish on space, and Rocket Lab is the only public company that is really focused on this area pretty well. And then Rivian, because future of cars is EVs and autonomy, and they're second to Tesla on both of those with just a ridiculously low, what is it, $20 billion valuation. So, and this company is like up pretty significantly today as well, up 4%. Meta, because so Meta is my fourth largest position, and the reason for that is because it's on par, in my view, with Google and Apple and Microsoft in terms of like its capabilities and mind share, but it has the best fundamentals, meaning like Meta's PE is only 22. It has a faster relative to Apple, Google, and um, um, Apple. Why am I drawing Microsoft, whose PEs are all in the 30s? So it has a significantly lower PE. If it just got the same PE as those three companies, it would already be $1,000 stock. So that's pretty. That makes Meta pretty ridiculously cheap, in my opinion. And then its revenue growth rate is actually faster than all three of those companies. It's 21% relative to Google at like 13%, and Microsoft is growing at an even slower pace. So, and Apple is like 6% annualized growth. So that's the reason I own Meta.
Wait,
And then
for
Bumble.
Meta, so for Robinhood, it was the future of finance, RKLB, future of space. What's Meta's, future?
Yeah, so it's like AI and AR, so augmented reality, which the glasses, I think it is going to be like we're going to want to have 24/7 access or close to it while we're awake to access to AI. And ideally, we want to have that access in a heads-up display with mics and video that can like listen and watch what we're watching so that it can give us feedback on all of those things. And phones can't technically do that because they're in our pockets. So I do think that the future is some kind of augmented reality glasses, and Meta is on the forefront of that as well. So when you combine augmented reality with AI, then the combination of the two, I think I'm pretty excited about. And like that has zero revenue for them so far. They've just been in R&D, or zero is in a rounding error, hundreds of millions of dollars relative to their 200 billion run rate, but they've been spending a ridiculous amount, tens of billions of dollars per year on research and development in that area. So they're way ahead of everyone else in this field. So that makes me pretty excited. And then Bumble, of course, I discovered these guys because of the value, which so far has been a value trap, meaning that the company's significantly lower than the average price that I bought it for. But my bet here is that Whitney can turn this company around. Dating and love is something that's universal and is going to continue to be wanted and needed. So if she can crack this nut for the next generation, you could have a Bumble that actually grows as a company with AI built products, and they could also venture into other products for women. So I think the future of dating, Bumble is in a pretty good position to potentially figure that out. It's not a solved problem. It is an issue for all of the companies in this space, but Bumble in particular is exceptionally cheap, which is what is attractive about it for me. So yeah, those are my 5 holdings now, and then my largest position, of course, being cash, is the other. So yeah, what do you think? Any comments on that, Dustin? Are we having any kind of technical issues? Oh, okay. So I can hear you, Dustin. If you can't hear me, let me write to him.
So yeah.
So if you guys are
sorry,
okay,
my microphone and headphones disconnected.
Oh, okay. There we go. But now you can hear me?
Yes.
Okay, cool. So we can hear you as well. And now we see you without the headset. So you almost look like you have a different hairstyle without the headset than with.
I know. The headphones keep everything in. I'll try to reconnect maybe in the middle of the episode.
Okay. But yeah, so those are the 5 holdings summarized as to why I have them. And yeah, what do you think?
I think all of that is a good perspective. I mean, jokingly with Bumble, talking about like love is, needed and wanted universally. Robots could also solve that
No.
and might. So I think that's the
Um,
biggest risk there. Um, and then and we've talked about this at length. I do think it's interesting, like when like how you choose to go with player number one versus player number two, meaning like picking Rivian over Tesla, or depending on how you look at it, like Meta in regards to AI is not the number one party, but in
well,
AR, I would argue they are.
OpenAI is not public though, so I would consider OpenAI the number one
Yeah,
player
but I would
in
say
AI.
maybe Gemini
Google.
would be number two
Yeah,
with
that's
Google.
true. But but I feel like OpenAI is going to continue to beat Gemini, and but we'll talk about Google in just a minute. But did you have comments on other things as well, or
Um, I don't think so. I mean, I'm a lot of our holdings are the same,
right?
if not at this point all of them. I think all the
Really?
ones that you have left, I also own.
Okay, very cool.
Yeah,
You made some trades this week, right? What
I
were
did.
your trades?
So well, it was just today I sold Robinhood
Okay,
because this morning they were up like 8%, and it just seemed like there was a couple things. It was like having a big pop, especially when the market's kind of down. I just felt like it was good to take some chips off the table. And then
okay.
we've talked about this a lot, but and disagreed a lot, where I think Robinhood is very tied to crypto. Not that it should be, but that the market it's
Views it
fairly
that way.
connected from a market perspective. And look, that could change, and I could be wrong, but historically that's been the case. So while crypto is in a weaker state, I want to take profits on Robinhood while it's up. And the funny thing is, if you look, so I sold roughly at the same point, a little bit lower, but roughly at the same point back in September.
Okay.
So it's like, I one could argue I could have sold 20% then as opposed to 10% and 10%. Um,
Well,
but we,
I think it's good to sell slow because, like, typically, especially when the momentum is on an upward direction, that like things tend to continue to go up, which is a lesson I've learned. I've always been like historically, 10, 15 years ago, I would have sold everything as soon as I thought something was overvalued. I'd be like, okay, I'm going to just sell everything, and even if I thought the company is a great company. But for great companies, one of the things that I've realized over time with investing is that they continue to go up in an overvalued state, meaning like like Microsoft in the 90s just was always overvalued, and it just kept going up and up and up in an overvalued state the entire time as the 90s was its heyday, and then it had sort of like a 15-year hiatus under Ballmer. Um, and then
right,
started going up again in an overvalued state under Satya Nadella. Um, great companies tend to be that way, but there's also overvalued and ridiculously valued, which we'll talk about a little bit when we talk about Michael Burry short on AI. But yeah, so it makes sense why you would only sell 10%. So you sold another 10% of Robinhood today.
technically a third 10% because
Okay,
I sold 10% also back in January
gotcha.
2024 because Robinhood moved up so quickly after I initially bought it. Um, and that was, in hindsight, that was a silly move, but it
Right,
just
right.
felt right at the time.
Very cool. Yeah. And you're at like 5.4% cash, it looked like. So your
Yes.
cash position is still relatively small too. So it makes sense that you're like selling some stuff as things are making uh
Yeah,
highs with the
and
sort of
by
a
the way,
turbulence market.
nothing has, from my perspective, nothing has dropped enough for me to like be interested in buying with this like current downturn. Like I was looking at all my holdings and I've purchased everything except for Bumble at lower points, so it's not
Yeah,
very interesting
attractive. Yeah,
for me while my cash is low. If I had more cash, I would come
maybe.
at it with a different perspective. Um, so yeah, I'm just trying to build up my cash position to around maybe like 10%, 15%
Okay.
max. Um,
Yeah,
and
that makes sense.
yeah, and as you say, either I'll sell enough to get there, or the market will just sell off for me, and I will get there.
Hopefully the former rather than the latter.
Yeah,
Um, yeah.
either I'm mentally prepared for either.
Okay.
Yeah.
What should we talk about next? Should we do the Michael Burry short, or was there other things that you wanted to talk about? Oh, the
Uh,
Nvidia versus
yeah, whichever one you
Google.
want to do, we could do.
Let's do that first because that was super interesting. It sort of hit yesterday. Um, what triggered the sort of Nvidia uh, turmoil is basically uh, Meta apparently is in rumors to be buying billions of dollars worth of Google TPUs, which are tensor processing units. They're designed specifically for AI. Google just released their seventh generation. So Google has been building TPUs, their tensor processing unit chips, for around a decade now. So like they started for a long time ago because they've been doing various different AI things for some time, and they've optimized these chips for AI specifically, and now they're selling them to other like other companies who want them. And Meta just bought like or might be buying billions of dollars worth. So that all of a sudden has caused the market to be like, oh, wait a second, like if the world starts to transition off of Nvidia GPUs, which are more expensive, the cost per watt or cost per token, however way you want to measure it, the 75% margins that Nvidia has make them the most expensive chips on the market. This might chip away, your pun intended,
There we
like
go. That's what
like
I like to hear. You know it.
at Nvidia's market share, and if not their market share, then certainly their profit margin, their gross margin, which is really really high. And I think that's a valid concern. But then, like to add fuel to that fire, Nvidia put out a tweet basically congratulating Google on their TPU progress, but also touting their own chips as like the best ones because they run all the models, and then sort of the take by the investor community was that why would anybody who's not afraid and is in a leader position even respond to something like this unless they were afraid? So this is one of those things where you're damned if you do, if you and you're damned if you don't. If the Nvidia doesn't say anything and stays silent, people are going to write the book about it anyway, and they're going to like call it doomsday. And like I've heard this story before, like 100 times. And if they do respond to it, then it's like, oh, they must be worried, and that's why they're responding to it. Well, this literally has happened over and over again with different companies. Pick TikTok against Meta, or Amazon Prime versus Netflix, right? Prime Video, or when Apple launched their sort of TV service versus Netflix again, right? So like these types of things, when competitors come in and sort of challenge the number one company, they tend to have these type of narratives. And whether the company responds or doesn't respond, it's negative. It's viewed as a negative thing, right? If they respond, it's like, oh, they must be worried. If they don't respond, it's like they're clueless.
The
And
number one player cannot respond. The number two player, they could do whatever they want. Like look at the Mac versus PC ads that they used to do, where Apple,
right,
when Apple was number two, like those were
right,
great because they were punching up, but you never
yeah,
want to punch down.
yeah. No, I agree. So that's sort of like a pretty deep marketing campaign, but this tweet, if you will, I think was overblown and like caused a 3% drop in Nvidia's stock price, which, by the way, 3% is like roughly 100 and what, $20 billion of market cap drop for Nvidia. That may have been the most costly tweet of all time. But yeah, so like I'm not sure that the Google TPU thing is a huge concern for Nvidia, considering how much there is room to grow. Meaning, like if we could, and right now, and we're going to talk about the AI bubble, but right now, if you could apply AI to 100 times more things, um, because the cost was a lot cheaper than it is today, then you would, because like right now, most of your mail is not being read by AI and like summarized for you, and like really actually even being responded for you, or most people don't have an AI assistant yet, right? Like there could be all kinds of AI doing all kinds of things for us that we don't have the computing power to do, but all of it is sort of technically possible using today's technology in AI. It's just that the processing power is not available to us. So I think there's plenty of growth opportunity there, which brings us to sort of like the Michael Burry, who sort of famously predicted the Big Short, or the financial crisis.
Yeah.
And they made a movie about it called The Big Short. He is sort of saying that there's another AI bubble, and there's a few reasons behind his position as to why there is an AI bubble, and it's worth talking about. Are you ready for us to move on to that topic, or do you want to
Yeah,
stay
we
on
can
the
move on to it.
TPU versus?
The one thing I want to hit on with NVIDIA and Google is that like NVIDIA will eventually not be number one. How long that takes, who knows, right? Like, is it tomorrow? Is it in a year? Is it in 10 years, 20 years? Like, you look at BlackBerry, right? They were number one until Apple. Apple, you had a bunch of people calling for an iPhone killer with Android. That hasn't happened. And I'm team
Right.
Android, but that hasn't happened. So, like, when I see things like this, when people are like, oh, Google's gonna, you know, overtake NVIDIA because of their TPUs. I'm more of a I'll believe it when I see it type of thing. And I know Meta's maybe doing this order, but that we're a long ways away, in my opinion.
Actually, yeah, I agree with that. I think usually the number one player stays number one for a lot longer than people think, because usually it takes a disruptive technology to unseat the number one.
Yeah.
And in the chip market, it might be easier just because there is no consumer loyalty to any
Yeah, it's
particular
strictly
chip brand.
business.
It's strictly business. So these decisions are being made in the background. You don't care as a consumer whether OpenAI or ChatGPT uses tensor TPUs or GPUs from Nvidia. Like, who cares? Like, you don't even know what it's using or AMD chips or whatever. So they can make that swap pretty easily. So there's less consumer loyalty there, and therefore it might be easier to unseat the number one. But historically, especially for consumer-related brands, to unseat the number one, you kind of have to have some kind of disruptive technology come around that makes something 10 times better or 10 times cheaper, and that is sort of like the catalyst as to like what causes the transition to happen. And Google's TPUs, are probably going to do well, especially in a rapidly growing chip environment. But they're probably not going to unseat Nvidia. That would be my guess. And by the way, like others have been doing this chip replacement thing for specialized purposes as well. So a perfect example of it is Tesla changed out their chips from Nvidia chips in their third generation of their full self-driving hardware. This was done roughly, I want to say 5-6 years ago, where they actually switched over, or 5 years ago maybe, they switched over to their own AI chips that were optimized for self-driving purposes, and they needed a subset of the instruction set that NVIDIA chips had, and therefore they could make a chip that was way more optimized, way more power efficient for their purpose, used less than 100 watts versus 300 watts of power. And Tesla has been using those chips in all of their vehicles for inference, which is what the car uses to decide what to do. And both their hardware 3 and hardware 4, and of course the future is hardware 5, is going to be using Tesla's own chip. So the sort of like custom specific chip for specific purpose has already been something that has been going on for some time. The same thing also happened in the mining community. Initially, everybody was using NVIDIA GPUs until specialized chips were like way more efficient. They were like to the tune of like hundreds of times more efficient than NVIDIA's general purpose chips. So, in this particular case, AI is big enough to where I could see NVIDIA coming out with a series of chips that have like reduced instruction set. This is something that has been going on in the industry for some time, but more optimized and maybe cheaper as a TPU alternative that they'll respond to Google's chips in that way. And all of a sudden, they'll continue to secure their number one position. And these are the reasons why the number one player oftentimes doesn't lose that position, is because they usually have the talent to continue doing and innovating in these areas, unless there's a disruptive technology where the talent is somewhere else. And I don't see that happening in the short term. So
Right. Okay, let's move on to Michael Burry shorting Nvidia and Palantir. Why don't you tee it up and talk about it? I'm going to try to connect my headphones because my ears are getting cold.
Okay. So I'm going to pretend like you can hear me the whole time. So I assume you will be able to.
Yeah.
Okay. So his premise on shorting AI and specifically picking on NVIDIA and Palantir is that the NVIDIA chips are being bought in these massive clusters that are being depreciated over a 6-year time frame. But the chips life cycle is probably not 6 years. It's probably only 1 or 2 years. That's his speculation. And therefore, the 6-year depreciation of these assets is too long. So when, for example, let's say, Meta says they're going to spend $60 billion on these data centers this year, what that really means is that only $10 billion of that $60 billion is going to get depreciated this year, and then another 10 billion next year, and another 10 billion the following year, and so on. But they spend the 60 this year, so their cash flow wise, it's a pretty significant hit. And he's like partially right. The cash flow hit is pretty real and it's immediate. But these companies' cash flows are so large that they can absorb that $60 billion hit in the given year that they're doing it. But they're depreciating it over 6 years, so their profits continue to be pretty substantially higher than the cash flow would indicate. So, there's something there. There's like I would say there's a valid concern there. If these data centers don't last them 6 years and they got to be replaced with newer chips because they're so much more efficient 3 years from now, and all of a sudden you have to take 3 years of depreciation in 1 year. Now all of a sudden you're taking that $30 billion hit in the future year that you might depreciate all those assets. So, if he's right, there would be some accelerated depreciation that happens in the future. But these guys are not dumb. The companies that are taking these depreciations, they're not dumb. They're not short-term thinkers. Google, Microsoft, Meta, etc., are not short-term thinkers. They're not like thinking, oh, let's play with accounting because we're not going to be here 6 years from now or 10 years from now. These guys are all planning very long-term companies, and chances are the 6-year depreciation is perfectly valid. And 6 years from now, those data centers are going to continue to function with the same hardware that they put into them today, or maybe some percentage or high level of percentage of hardware that they put into them today. So on his concern for NVIDIA, I don't share that same concern. Now, if we move on to Palantir, Here's a different scenario, and it might be worth actually looking at, the fundamentals of these companies. So if we look at sort of NVIDIA, here's NVIDIA's, market cap is 4.4 trillion. Its PE is 43, right? This is its trailing 12-month PE. Price sales is pretty high, but the PE is way more important. And its revenue run rate for the trailing 12 months is
Can you
187
zoom
billion.
in?
Oh yeah, let me here. So hopefully this is a little bit more clear.
Correct.
The revenue run rate of NVIDIA is 187 billion with a 65% growth rate. Now, if these companies slow down and stop spending as much, and NVIDIA's growth rate becomes like 20%, similar to like Meta or Microsoft or whatever, then a 43 PE might be a little high. But chances are it's going to continue to grow at a faster pace than Meta and Google and Microsoft have been, and therefore this 43 PE seems very justifiable to me. Now, I'm not an Nvidia shareholder, and therefore I have like no skin in the game. I'm like trying to be like very, not like non-biased. I'm not actually biased. And if we look at Palantir, which is his sort of like other short bet, this is a totally different story, because here's a company that has almost a $400 billion market cap, 395. So we'll just round it to 400, with a $4 billion revenue run rate and 47% growth rate. So even if you take this 47% growth rate, and let's say we'll generously give them 50% growth rate for the next 3 years, right? That means the 4 billion grows to 6 billion, the 6 billion grows to 9 billion, the 9 billion grows to 13.5 billion in 3 years. So a $13.5 billion company, should a $13.5 billion company be worth 400 billion? I don't know of too many those kind of ratios where a $13.5 billion company revenue company is getting a price sales ratio of 30, right? So in that scenario where Palantir is growing at 50% annualized for the next 3 years, 3 years from now, its price sales ratio is pretty high for today's stock price. So, and this is, Palantir being off by like roughly 20% from its highs too. So, his short bet on Palantir seems to me a lot more justifiable than his short bet on Nvidia. So that would be my take on his sort of AI bubble position. The other
What's his
sort of like, yeah,
what's his
go ahead.
reasoning for shorting Palantir? Is it
Just
strictly PE?
I think it's just the numbers being like so high, like it is astronomical. Now, I think Palantir might be breaking all the sort of like rules in terms of a solid
All the
company
laws of
that is,
physics. Yeah.
yeah, the laws of finance. For a solid, mature company that's a multi-billion-dollar revenue company with profit, it's profitable. There's like Palantir is not going out of business. Just to be clear, like this is not a company that's at risk of like disappearing. But there's lots of examples of companies, and we've looked at some of them in the past where, if we look at, for example, Atlassian. Atlassian was one of these darlings, and I forget their tickers. Team was one of these darlings where the price sales ratio and stuff had gotten way ahead of its performance at the time. So if we go to like its earnings, you can kind of see this company has been growing rapidly on a continuous basis for the past this is the past 4 years. And we can even go like longer. Here's like the 10-year. This is a beautiful chart. This is basically what Palantir's growth chart looks like. But if we look at their sort of stock price on, for the past 5 years, they grew rapidly to like a $400, what was it here? $450 price point. And today you can buy the stock at $150 or less than $150. And the reason for that is because it just had gotten way out of whack up here with price sales ratios that were nowhere close to Palantir's, but way too high for a typical SaaS
Right.
company. So, so there's lots of examples of companies where they eventually come back down to earth in terms of price sales and price earnings ratios. So you can only escape that for so long.
Yeah, I agree with you. I mean, I don't know enough on the uh, depreciation side of things to
Mm,
know what's real, what's not. Because to me, it's all like I just need to trust a source.
right.
Um, but with that said, I don't like just. It's a fallacy to believe because Michael Burry got the housing crisis right that he's going to get this AI bubble right, or even
Right.
Palantir right, even if we believe that they are overvalued.
He's actually
Um,
been pretty notorious for getting things wrong since then. I think the running
well, I
joke
think
is that he's predicted 17 of the last two
it.
bear markets.
Yeah, it's very. I mean, it's very difficult to get things right consistently. That's what makes investing difficult, right? So, like,
Right.
and I'm not like he's a very smart guy. It's just the nature of the beast.
Right.
So I don't really give it a lot of weight personally.
Yeah.
But speaking of the AI bubble, we had a question from a listener last episode asking, what are our hedge strategies if there were an AI bubble and it were to burst? So,
Yeah.
how do you think about that?
That's a great question. I mean, I think that I think of it as my portfolio, a hedge on my portfolio, not necessarily an AI bubble hedge, but
Mm.
what's the hedge on my portfolio? Because as my portfolio hits all-time highs and does so like or was doing so every week, until 3 weeks ago or whenever it was the market sort of like decided to start making a
Yeah.
correction. uh, the question is, how do you hedge? And you can try to buy options like put options essentially, which expire after a certain period of time. And options in general are designed much like the casino is designed to favor the writer of the option, meaning like most options on average will expire worthless, or the collected fees will, like if you think of all the options that are being issued, the fees that are getting collected by the option writers will sum to a larger amount than the wins that the people who take the options, buy the options, will get at expiration. So you could be right, but it's kind of like gambling on number 18 on the roulette table. The casino is going to win most of the time, right? Like, but some of the time you're gonna win. So options are much more closer to the casino and gambling than investing in general is. So I do buy options, and I don't disclose them in my Savvy Trader portfolio because lots of reasons, but we also don't support options in Savvy Trader. But the way in which I buy options is usually like with a long bet, meaning like I usually want to own more of something, and I'm like very disciplined about buying it slowly. But then I'm like, well, if the price goes above this, maybe I'll buy some like options at that price so that I don't miss out on like the total amount of shares that I wanted to own. So in some cases, I'll buy options to sort of like make a positive bet. That doesn't actually hedge my portfolio. So the way, coming back to this sort of hedging, I don't hedge. The way I sort of de-risk is by having a larger cash position. So as my portfolio hits all-time highs and sort of like makes new all-time highs, you basically seen me taking more and more profits. And today I have like 30% of my portfolios in cash uh, as a result of that. So the cash makes it sort of like the bumps a little bit more smooth as opposed to like huge drops on the portfolio value. So uh, that's the way I look at it. I mean, there are other ways, obviously, but generally speaking, hedges are going to, in the long term, work out against you. unless you happen to have some insights and you do a pretty major hedge that gives back pretty significantly, and then like that might make up for all the past incorrect hedges.
Right. Yeah. Personally, I am not smart enough to know what's going to go up if the AI bubble bursts. So I'm with you. I know cash is fairly stagnant. So it's not going to go up or down necessarily during inflation. So I'm
Yeah.
aligned.
All right. What else do we
Let
have?
let's just quickly talk about last episode we talked about your friend's investment strategy.
Yeah.
And I just want to circle back to that because we mentioned that we could potentially share that PDF with everyone. And then let's go into listener questions.
Okay. So yeah, so that PDF is going to be a link, and I asked him if he would be okay for us to share it, and he said, yeah, absolutely. And so we're going to share it. It's not investment advice; it's just something he's prepared for his friends and family. So you guys are welcome to take a look at the PDF. There's some, I think, like valuable info in there for, especially for people who are like, I wonder how, like, how do other people think about investing? And I think that's a good perspective to have on that document. It's not investment advice. Let's just make that clear. And then one of the
And
cool things that
it'll
I
be
think,
in the description on YouTube.
oh yes, it'll be in the description. That's what I meant to say. We put it in as a Google Doc link in the
Yep.
description. We will put it in as a link in the description. But one of the cool things that document includes is these scenarios that if you start out with, let's say, $10,000 and invest $1,000 a month, or add $1,000 a month to the investment, and you average 20% returns, or he has it at like 5%, 10%, 20%, or whatever. If you average 20% returns after 20 years, your total is going to be 2.6 million after 20 years, which is pretty incredible if you think about it. Like, let's say you are in your 20s, as you are, Dustin, for example, right now, and
I don't know if I'm in my 20s, but thank
wait,
you.
did you turn 30? How old are you?
I turned 30 2 years ago.
Oh, okay, 32. Okay, like when you were in your 20s when we first started working together. So
Yes,
it's just
yes.
like imprinted
And
in the back of my
I
head.
I do like to think I don't age as well, so I appreciate that.
you you do look very good. So let's say, okay, 32. You're 32. Many 32-year-olds should have access to, I don't know, $10,000 of like money that they can set aside, that they could lose all of, but or afford to lose all of and be okay, into investing, and then add $1,000 a month. If someone is in that boat, by the time they're 52, if they could average 20% returns, that's 2.6 million. So it's pretty incredible potential returns for someone to have. Like, it's a very sizable um, thing. But anyway, it's the document is just 2 pages, and it sort of talks about some of these things. We can move on to viewer questions if it makes sense.
Let's do it.
Hey guys.
Hi,
Hello.
Adrian.
We've got a few different questions on cash. So let's
Okay.
dive into those. Let's go to a listener on X. What is your philosophy for holding so much cash, especially in an investment account? Why park it there instead of an MM or use it
Money
to invest?
market.
Money market. So it actually is in a money market. It's so in Robinhood, they give you, they kind of automatically do that for you. So your cash is, if you're on a Robinhood Gold subscription, is already earning, I think now it's 3.5%, if I'm not wrong. On like Fidelity or Charles Schwab or whatever, you have to buy these specific tickers that are basically money markets that are yielding similar, somewhere between 3.5 to 4%. And
Vanguard's at 3.87%.
Vanguard is so
Yeah.
3.87. So the answer is that they are earning interest. The cash is earning interest at those rates, but it's still considered cash because it's like a relatively safe like the value of that should not go down below the amount that you put into it.
Yeah, and those rates, at least right now, are higher than what inflation, the target of what inflation should be, right? Like it's higher than 2%. If the
That's
rates
right.
were lower than 2%, I would maybe think a little differently about holding as much cash.
Yeah,
But
it might make sense in that scenario to look for cash alternatives, which would be great. Cash alternatives would be high dividend stocks that end up giving 5-6% of dividend. But I owned a lot of AT&T during the sort of like time that I thought the market was super overvalued in 2021, 2022, and all the dividend that they paid, it sort of like evened out with the stock going down throughout that period of time. So you kind of got to take that with a grain of salt. But anyway,
Okay, we have
what else?
2 questions that are kind of similar, so I'm going to throw both of them up there.
Okay.
So, what specific market conditions or valuation metrics lets you hold a significant cash position? And when do you deploy capital aggressively, knowing that timing the market is problematic? And then
Yeah.
let's go on to
Okay.
uh,
Let's read the next one, and then we can answer
what
both of
would
them at the same time.
okay, what would have to be true in the market in order for you to invest your cash? If every market dropped 40 to 50%, hypothetically, what would be your next move?
Yeah. So like when I let's pick specific stocks, because I'm like a very specific stock investor, meaning like I have very concentrated bets on very few companies. So I have 5 companies right now. They are Robinhood, Rocket Lab, Meta, and so on. So when I was buying Rocket Lab, it was in the 3s and 4s and 5s. That's when I had purchased the most number of shares of Rocket Lab. When I was buying Robinhood, it was in the $7 to $12 range. That's when I accumulated the most amount of Robinhood. So as these stocks have like now 10x from those price points, the risk, in my opinion, is significantly higher for those specific stocks. So even relative to the rest of the market. So therefore, I have reduced my position substantially in those companies, and I haven't found other companies that I'm like, wow, these other companies are like great value, where like I love them, and I want to sort of like own a piece of these other great companies at a great price. There are lots of great companies. I think like Google is a great company. I think Apple is a great company. I think there's lots of great companies out there, but the great price aspect of it hasn't been there for me to purchase them. And then when you combine that with the market basically as a whole seeing all-time highs over the past year, and my own portfolio being as up as much as 100% year to date, now it's closer to 70 or 80%. So it's gone down a little bit of a correction, but it's still a pretty abnormal year. 70% up in a single year is a pretty significant amount. And therefore, I always think that like, the writing's on the wall. It's going to happen at any time. Like there's a part of me that is always afraid. And it's sort of like one of the quotes that has stayed with me for a long time is this quote from Intel, one of Intel's co-founders. Oh my God, I'm drawing a blank on his name. Andy, what's his last name? But anyway, the quote is and it's actually the title of his book called "Only the Paranoid Survive." It's actually worth looking up. Only the Paranoid Survive. Where is his name? Andy Grove. So Andy Grove was co-founder of Intel, and he wrote this book, "Only the Paranoid Survive," and it's a great book, and it talks all about like 10x technologies that he looks for and things that he looks for in building a company as great as Intel. But anyway, that quote stuck with me, that only the paranoid survive, and I think there's some aspect of that should be applied to all aspects of life. And I'm like always paranoid that the market is going to collapse at any time, And if it does collapse, there's sort of like unanimous agreement that there is, the market has collapsed. And in those type of scenarios, then it's like, okay, well, if it has already collapsed, now's a good time to go in and go look for bargains, right? And I think that's when I would be looking to deploy a significant portion of cash. Now, because this year has also been so good to me, a significant portion of my cash is also going to end up being sent to Uncle Sam. So, we'll see how that turns out in the next few months. But I do expect to have a pretty substantial tax bill, which is going to reduce my cash position as well. So, hopefully that's a long answer, but that should answer all the questions around cash.
Well, we have one more, and it ties into what you were just talking about. Hamid, I just realized my current 25% cash position will be more like 12% after I pay capital gains taxes. Do you build
Yes.
a higher than normal cash position toward year end to account for taxes?
Yes, absolutely. I think that, or if you don't do it at year end, you could also do it at the beginning of the next year, or whenever you have to start paying the taxes. But I'd rather do it on my terms rather than be forced to do it. So as stocks hit all-time highs, and I'm like, okay, like I want to take some profits on this particular position, I will do that.
Also, if you're not taking that into account and then you have to sell.
Dustin, did you do something with your mic? We can barely hear you.
Really? Should I talk like this? Is this helpful?
Oh, yeah, that is helpful, actually.
Yeah, I'm just going to talk into the mic.
Okay.
What I was going to say is if you aren't accounting for taxes and you need to sell investments every year to pay for your gains, it's just like creating this domino effect of then you're going to have to pay the gains on the investments you sold the following year. Like,
Right.
I don't know. It's just it just feels a little out of control, right? Like to Hamid's point, like you want to, be in control of what you're doing with your cash and not be forced to sell anything.
Forced to sell, yeah. It's also part of the reason I don't use margin, is because I don't want to be forced to sell stocks when they're at their lowest, right? Like if I'm buying stocks and obviously if I'm buying extra of those stocks using margin, that means I've thought that the price is really, really good. And to the point where I'm willing to borrow money to buy these stocks, and borrowing money to invest just seems like a very terrible idea in general. But then in order to get a margin call, that means those stocks go down even further, which means that the stock price is even more attractive. But now you're forced to sell your stock in order to pay off the debt. That's called a margin call. So I never use margin for that reason. And I shouldn't say I have, but largely when my main asset was my company, and I had income from my company, and the amount of investment I was doing was significantly lower than my income level. So at that time, I felt comfortable using margin because like my income could cover it if necessary. If I got a margin call, I wouldn't be forced to sell. I could just put in more money into my investment accounts, whereas today I couldn't do that. So,
okay, let's do one more.
Okay.
What are your thoughts on SPY, QQQ, or ETFs in general? Do either of you hold them in outside accounts or a 401k, which chooses the investment lineup and usually can't do individual stocks?
Dustin, why don't you take this one first, and then I'll answer mine as well.
Yes. So in my retirement account,
can you bring the mic closer? I'm so sorry.
No, you're good. Is this better?
Yeah, that's much better. Adrian, can you hear him okay when his mic is too far?
No, she also commented that my mic's having issues.
Gotcha.
Hopefully it'll be fixed for next episode. So I am invested not directly in SPY. I'm invested in a Target retirement fund. In
your mic came back. Yeah. So now we can hear you better. Yeah.
I increased the volume manually, so
Oh,
Oh, thank you.
Yeah, you're
I
welcome.
wonder if there's like some shortcut key that we accidentally pressed on you.
Yeah, probably. Okay. So I have a target retirement fund of like 2060 retirement fund because I'm 32, as you know. Um, and that's my main investment in my retirement account. Eventually, I'll move away from that and invest in individual stocks more, but I'm still building up my confidence to do that. I just like the distinction of like, okay, this is retirement money, and then my investment portfolio is more like fun money, experimenting, honing my skill set, and then I'll eventually bring it over. But
Yeah.
yeah, so arguably my biggest investment is in just SPY.
Okay.
When you look at it
Interesting.
that way, yeah.
So, I've been investing for roughly 30 years, which seems kind of crazy. And ironically, I had a lot more index and mutual fund investments in my 20s and 30s than I do today. And it should have definitely been the other way around, meaning like if I was going to be picking individual stocks, I should have been doing them in my 20s and 30s as opposed to today. But I also did individual stocks. I just compared, like I would put half of my money managed by a professional investor who was investing in S&P 500 or mutual funds, like trying to de-risk and spread the investment into a diversified number of assets. And what I realized is that the individual stocks that I was picking were just like killing it in relative to these diversified assets. And then after doing this for like 10 years, I'm like, the disproportionate growth of like the individual stocks versus the tiny little investments that I had in the other ones, they all started out the same, but this one was so much larger. And why was I doing it this way? Like during the time that I could have risked a lot more when in my 20s and 30s, and as I had this income from my company or whatever. So I realized, no, I should just go all in on investing and picking individual companies. It seems like the exact opposite type of advice that financial advisors give you, which is why I don't give financial advice. But I realized
I thought you
that
were
in
going to
order
say,
to,
which is why I don't listen to financial advisors.
and I don't listen to financial advice. But what I realized is that in order to build wealth, you actually need to make concentrated bets. And this is sort of like been something that Warren Buffett has been saying for 30, 40 years. It's nothing new, but I just heard it for the first time when I personally experienced it, right? And I was like, this is so dumb that I've been doing it this way. Um, and like some of the best investors, Bill Ackman, who I don't consider a great investor personally, but even if you look at his hedge fund, it's invested in like 6 stocks and he's managing billions of dollars, right? Like, so if billions of dollars worth of investment are being invested in like 6 or 8 or 10 or 15 stocks, or in Warren Buffett's case, he's managing hundreds of billions of dollars and investing them in then like 90% of that money is going into a handful of stocks. Then why should individuals be picking the S&P 500, which is 500 stocks? You basically limit the upside potential, and that's why I don't do it. But yeah, I have zero invested in SPY or QQQ to answer that question. So
Okay,
all right.
sorry, I've got some background noise, but I think we should just wish our listeners a happy Thanksgiving.
Awesome. Yeah. Happy Thanksgiving, everyone.
And happy Black Friday.
Yeah, hopefully we gave you some topics to talk about at Thanksgiving conversations. Why
Totally.
Michael Burry is wrong, or why the AI bubble is definitely happening, or whatever. But anyway, thank you, everybody. Bye.
Thanks.